This is our special episode for NRIs. We've been receiving a lot of emails from investors overseas who want advice on their investments in India and the taxation of their investments. So on this episode, we will attempt to answer all of those questions. Now remember, the advice you hear on the show today might come in handy for a family member or a friend you have who lives overseas. So grab a pen and paper and let's get started. You can write down the email ID that's at the bottom of your screen right now and send in any questions you might have about your investments. Let's get straight to it. To help us answer your questions in the studio today, Pranav Saita, the head of tax at Ernst & Young, joins us. Prakash Diwan of Fasit C. Mehta will help us with our equity investments, and of course, no show is complete without Virendra Kumar of Value Research, our in-house mutual fund expert who joins us in our Delhi studio. Gentlemen, thank you so much for joining us on the show. Now, I want to begin by asking you the fact that we've received a lot of emails from the Gulf. It would seem like these investors are banking on their portfolios in India to pay for their retirement. Virendra, I want to start by asking you about the asset allocation of an NRI. Should it be different from a resident Indian?
There are two, three things which comes to my mind. One is that, there should be no difference in asset allocation when it comes to NRIs or resident Indian. I don't think that makes a difference. That is basically a function of how far you are from your goal. Particularly from a fixed income point of view, your approach changes if you have to invest in India and you have to repatriate it back. And the other case, the people in Gulf who have, clear plans that they will come and retire in India, or at some point they will get back and they would like to have their assets here. So for them the approach is different. So repatriation is one of the key differentiation, and I think India provides a distinct advantage on the differential higher fixed income return.
Right. So it's important, like Virendra said, you have to consider when you're making your investment choices if you're going to take that money back to the country you're residing in, or you plan to invest in India because you plan to reside in India. We're going to come to the taxation on those investments in a little while. But Prakash, tell us, for someone who's watching from overseas, for the Indian equity market, over the next, say, 5 to 6 years, because these are long-term investors, where do you see it going?
I think, as I said, the India story is pretty well known amongst all of us, including people who reside outside the country. But the last few years, of course, seem like a pause in that ascending growth story that all of us are very happy about and very enthusiastic about. But my sense is, given the fact that we're growing at a 7.5% GDP clip and the inflation being in the same 7 to 8%, you could possibly expect a CAGR of 15%, 16% for the next 5 years, which means, simply speaking, your money does double in that period, in those 5 years, if you were to invest into equities. That's the least that you could expect, and I'm sure it could be more, but that's the least that you could expect.
Virendra, there are two ways to approach equity. As we know, there's direct equity and there's mutual funds. We've got a lot of portfolios that NRIs have sent in to us. And we'll see from those portfolios that they tend to invest in a lot of funds. They have 20, 25, sometimes 30 funds in their portfolio, not always very well thought out. What would be your recommendation on how they should approach a mutual fund investment in India? How should they pick a portfolio?
I think the principles to follow is the same, that work on an asset allocation. You can't have an all equity or only all fixed income portfolio. So depending on your risk tolerance, depending on your time frame, choose that. If you have the time, if you have the inclination, and if you have some distinct advantage, build your stock portfolio. If you can't do all that, go for a good equity fund. Investors have been collecting investments like art, and more so because, NFOs, and they will be hogged as special stories. I think many investors have now understood, and also the business dynamics has changed to support an ongoing investment plan and staying on course with a plan.
So that's interesting information. Remember, don't collect mutual funds like you're collecting art, which means this is what a lot of the NRIs do. Every time they're back in the country, they buy a few more funds and add it to their portfolio. You need to have about 4 or 5 funds in your portfolio, and then you keep investing in those funds on a regular basis. Prakash, I have a problem with equity investments. It takes a lot of homework. You have to do a lot of research, you have to stay on top of the news, you have to constantly read about the stock that you've invested in. As an NRI, that must be even more difficult, given the time difference, given the fact that they're not physically here, so they don't hear about the news on a regular basis. How do they identify the companies that they want to invest in? How do they know where they're putting their money and that it's in good hands?
There used to be this information differential between domestic investors and people residing outside, where the information flow would take some time for them to reach. I think there's a lot of information available. What takes a little bit of more effort is the analysis part. So if you were to rely on reports from decent brokerages or research houses.
Can you give us a checklist of 3 or 4 things I should find out about the company that I'm investing in to make sure that it's a good investment?
Oh, absolutely. I mean, I would start off with a simple analysis of the of the broad balance sheet numbers. that's the starting step irrespective of where you invest in the world. The second would be go to the stock exchange sites, check out if there's been any track record in the past which is circumspect or of any doubtful nature. Go to the website of the company, make sure there's a good investor relations package out there. And all the information you need would be available, including quarterly results, events, updates, everything. So if you have these 3-4 things in place, I don't think you're going to get misled.
Alright, so now we come into the really interesting part of the show, and that is tax. Now we know there are 2 types of income tax you have to pay as an NRI. There's income tax and there's capital gains tax on your investments. Now to make that simpler, we've put down the details that will help you understand when you need to pay income tax in the country in this report.
Calculating your taxes is always a tedious task. And for an NRI, the process and rules become even more complicated.
Broadly, there are 2 categories of taxpayers, residents and non-residents. And the difference between the two is ultimately decided by the number of days of physical presence that the person is present in India. So for instance, it's a presence of 60 days in a given tax year, and previous 4 cumulative years, 365 days. That is the first rule of residence. The second rule is a threshold period of 6 months stay, which is a 182-day present. If any one of these conditions is met with by any individual taxpayer, that person becomes a resident of India.
Residents can also fall under the not ordinarily resident category. This requires a resident to fulfill either of the 2 conditions. He has resided outside India for 9 out of the last 10 years, or he has spent less than 730 days in India over the last 7 years. Now, if you do in fact qualify as a non-resident, the income you earn overseas is not taxed at all. Your salary and the income you earn from investments abroad will be taxed under local taxation laws and not those in India. But your residential status doesn't bar you from investing in India. So as an NRI, you can buy a home and invest in the equity markets without being taxed on them. However, any income that you earn from these investments will be subject to taxes. The rent you earn from your property and the interest earned on various investments will attract tax as per the Income Tax Act in India.
If he or she continues to have investment income in India, for example, maybe a rental income from property or certain investments in India, that income is sourced and received in India. So the non-resident person, despite staying outside India, would continue to be liable to pay taxes on any income that he or she receives in India or is earned in India.
While there are many exceptions and subsections to the laws that govern taxes for NRIs, these are some of the basic fundamentals that you need to keep in mind while planning your finances.
Alright, so those were the rules, but Pranav, this is where I bring you in. There's a DTC that we're all looking at. We're hoping we'll see it maybe in the next year or so, perhaps. But the DTC changes rules drastically for NRIs, doesn't it? What would be the change in those rules?
So I think primarily the one rule that majorly changes is the rule that makes a non-resident and converts him into a resident. So presently, if an NRI, so to say, were to come on a visit or visits to India during a particular year, he is allowed to stay here for as many as up to less than 182 days of the year. And notwithstanding the fact that he has been here, for example, for 180 days, he may still continue to be a non-resident. The DTC, as we presently see it as proposed, does away with the concept of not ordinarily resident, though that concept of NOR, not ordinarily resident, which has been sought to be removed, may not have any major income tax implications. It does have some implications from a wealth tax perspective. But the more important change that the DTC is likely to bring about is, if the concerned non-resident was on visits to India for more than 60 days of the year, and he has spent more than 365 days in India during the last 4 years, then that could make him a resident of India. And that's really the rule. The 60 days which gets substituted for 182 days for visits into India by non-residents. That's the rule that really is likely to...
And this applies also to people who work in the merchant navy, who possibly are air hostesses, who spend a lot of time traveling. So that also comes in when you count the number of days you spent in the country.
Absolutely. So that's the rule which is going to be the most sought after to be changed if the DTC were to actually become law. So there's a lot of representation surrounding that rule.
All right. We also have to keep an eye on when the DTC does come in, because we were expecting it on the 1st of April, but the chances of that happening seem slimmer right now. Okay, we're going to slip into a quick break. On the other side, we're going to talk about your debt investments. We're going to talk about your NRE and NRO deposits and find out what the taxation is on that, and if that's the best option for you as an NRI as well.